I think another element that has really come into play recently has been this confusion between correlation and causation. And it's driven a lot of factor investing model, enhanced indexes, and all of these approaches, and this ties a little bit to some of the forecasting comments, all of these have one fundamental problem, which is they rely on back tests. And they all have this mindset that, oh, well, if you had done this in the past, this is how it would have worked out. So therefore, it will work out in the future. That second leap is the mistake. Correlation is not causation. So beware of back tests and remember that patterns can change. Patterns between interest rates and stocks, or when oil stocks go down, bank stocks go up. These are crazy correlations that people sometimes attribute causation. I'm going to give you one really vivid example to think about, because we're a data-driven firm. So we think a lot about, well, maybe there is some validity to these things. Let's look at the data. So, about 20 years ago, a Professor Leinweber published an article in the Journal of Finance that actually showed some really remarkable data. He started studying different factors and their relationship to the S&P. And what he noticed was that he identified one factor alone that explained 75% of the move, an R squared of 0.75. He added a second factor and got that R squared up to 95, and a third factor and an incredible fit of 0.99, almost a perfect fit. So here it looked like, oh my God, he solved it. These factors, in essence, predict and explain the return of the stock market. And so it was a very powerful article that even a skeptic like me thought, well, with 0.99 R squared, that's really robust. And then, of course, at the end of the article, he unveiled that the variables, variable one was butter production in Bangladesh, variable two is cheese production in the US, variable three, the combined sheep population of both Bangladesh and the US. Obviously nonsense, obviously correlation, not causation. But remember, if those three variables had been, M2 money supply growth, trailing 6-month changes in unemployment, and, Fed monetary policy or some damn thing, you could see somebody ginning up an argument that this would be an investment discipline. So beware of correlation.